The return on the all-share index has dropped now to 11.3%. It's still looking like an attractive market, though, trading on a PE ratio of around about 16 times versus its 4-year average of 20 times. What are you making of current valuations?
Hi, Alishia. Well, yes, you're right. The performance to date has been relatively strong, but we still see opportunity in the sector. As you point out, the averages are still below, the Ps are still below the sort of average for the last 4 years. We think that in the sectors that are of interest to us, we still see some significant value in particular stocks, and I think it's really about picking the sectors and then picking the stocks within that sector, and we still see a lot of upside. We expect the NSE 30 to close the year at around 1,500, which is an upside of around 40% versus when we went to print on our latest report. So 2011, we're expecting around 40% gain in the NSE 30, which we still think is an attractive market for investors to look at.
Of course, we've had the banking sector still in the limelight, and that's unsurprising with the fact that it really dominates the bourse at this stage, making up 2/3 of the NSE. Let's take a look at a pick out of the sector that you hold, Diamond Bank. What's the investment case as you see it there?
Well, I mean, firstly, actually, the significance of banks has diminished, particularly since the listing of DCP. But nevertheless, they are still the most liquid and still dominate activity. You're right, we do like Diamond Bank. And our rationale for that really is that, we like the repositioning that we're seeing with that bank over the sort of medium term. The MPC minutes that came out earlier this week indicated that the average maximum lending rate for retail loans was still north of, 21.5% versus sort of the teens for the average prime lending rate, and the fall in that rate was much slower versus the prime lending rate over 2010, notwithstanding the fact that the market saw significant liquidity and a drop in rates. So we like the fact that Diamond Bank is attempting to tap into this retail market that has long been noised in Nigeria, but we see very limited concerted effort, certainly for the names under coverage. And we expect that to translate into preservation of net interest margins over the medium term, notwithstanding what may happen in terms of cost of funds. And basically early mover advantage, learning to take risk in that sector and make it profitable. We think these are important positionings for banks in this environment, and Diamond Bank is one of the banks that we see taking that position. We expect this to translate into a significant increase in ROE next year versus this, almost doubling ROE, and a robust sort of position beyond. And the valuations remain attractive. I mean, the PE is around 7.7 times, which is attractive versus our average for our universe, which is around 9.5, and 10.3 for the basket of emerging market banks that we look at. And price to book similarly, 1.08 versus 1.16 for our coverage universe, and around 1.64 for the emerging market basket. So we still see value in the name, and we feel that the strategy has merit in the longer term, and we see scope for margin preservation and increased returns on equity.
In delving into the banking space, though, there does seem to be quite a bit of political risk to consider on account of a possible, the general election coming up in April this year, and implications for the sector's reform process. To what extent does this weigh on your investment decisions when you're making them in the banking sector?
Well, to be honest, I think, anywhere in the world, whenever there's an election, people always have a certain amount of caution. So, it would be unreasonable not to at all reference that. I don't expect, let's face it, the reforms are well entrenched in law. They're not sort of a personality centric. So I think even if there's an unexpected outcome, at the general election, I think that the AMCON is enshrined in law. I think it's well underway in terms of doing what it needs to do. And I think that, the momentum is well and truly underway. But it is just a reality that, one cannot say hand on heart that we know every single thing that will happen, when an election takes place. And I think that there tends to be, an element of caution just as we watch events unfold. We think that, the strength of victory of the incumbent at the primaries to some extent also mitigates political risk.
What about the threat of increased fiscal tightening here? I mean, it could result in the pressure on the NIM to, as the cost of funds rise and banks will need to take greater risk to actually drive earnings. Do you see banks actually engaging in the level of risk that they need to in order to offset some of the impact on that front?
Well, interestingly, we've always kind of said that the situation sort of through 2010 was anomalous and it wasn't going to remain. The larger banks clearly have a natural platform for attracting relatively cheap funding. Yes, we expect rates to rise, but I think we're also at a phase in the sector's development where there is a realization that there must be greater engagement with the real economy. There must be, a more robust sort of financial intermediation process that takes place. So we expect, more modest loan growth versus what we saw in the sort of 2006, 7, 8 period. Nevertheless, we think that steady but sustainable loan growth is the order of the day for the medium term. And I know that the governor was just talking about fixing some of the structural issues that are an impediment to credit flows within the economy. And as these things kind of take root, as the Bankers Committee and the central bank work together to create a framework that facilitates lending, I think we will see a broader suite of options for banks to direct credit, and this will underpin loan growth. So I think over the medium term, if we keep doing some of the things that are being done currently, we will see those opportunities present themselves in more attractive forms, and I expect that banks will take those opportunities.
Well, there seems to be unanimous bullish sentiment on the fast-moving consumer goods sector in particular, forecasts suggesting that we're set to see a much better year this year than we did last year. Still lots of room to run within this space before we start getting into overstretched or overvalued territory, Rele?
Well, interestingly, I mean, I'm not sure what everybody else is saying, but as far as we're concerned, we have 11 names in that space, and we have 5 buy recommendations. So it is not a kind of we don't think that every name in that sector represents an opportunity. We think that there's a particular focus on food producers, the flour mills, the Dangote sugar, flour, and the like, as opposed to some of the higher, more expensive home and personal care entities that we think are relatively fully priced, or even the brewers at this point we feel are relatively fully priced.
Mm-hmm.
All of these guys on the long term are adding capacity in this market, and they clearly see upside given the demographics, given the growth outlook, given the level of penetration of some of these products in the Nigerian context. So we think that over the long term the sector is indeed attractive, but for now, certainly for 2011, we think that the valuations for the food producers in particular, flour mills is our sort of top pick in the sector, is more attractive than for home and personal care.